Good afternoon, everyone. Today, we are going to continue with Learning Unit 1. So we're going to continue with Learning Unit 1. And Learning Unit 1 is part of Topic 1. And if you check in your study guide, you will see that Learning Unit 1, which is part of Topic 1, we are supposed to be looking at Chapter 1 of the textbook. And Topic 1 basically covers Learning Unit 1 all the way to Learning Unit 3. Now, when you look at the material that is supposed to be covered for Learning Unit 1, which is Chapter 1 of the prescribed textbook, you also see that in the previous class that we just had, which was the previous weekend, we managed to cover sections 1.1 and 1.2 of the textbook. For those who are joining us now, please make sure that your administrator puts you in your WhatsApp group, based on your group. If you inquire with your administrator, they should be able to put you in the different WhatsApp groups where we'll give you instructions on exactly how to access the previous videos and also how to access the soft copy of the textbook as well, because we do have the soft copy of the textbook. So you should be able to access all that material as part of your material that you need to go through the curriculum as well. So in the previous class, we did sections 1.1 and 1.2 of chapter 1. And those who were not able to attend, you will be able to have access to the information from the different groups that we are going to give you as well. And we're also going to make sure that you create a user account on our website. And on that user account, you will be able to access the videos from the previous years, as well as the videos of the classes that we have done as well. And you'll also be able to access the soft copy of the textbook so that you use that material in preparation for the next classes as we go as well. So on section 1.3 of chapter 1, we now look at the capital asset pricing model. Now, where we look at the capital asset pricing model and where it's coming from, you will see that in section 1.1 and section 1.2, we did look at the relationship between risk and return. And to be specific, we looked at the relationship between risk and expected return. And we said, generally, from a finance perspective, we know the higher the risk, the higher the expected return that the investor would expect to get from their investment, right? Then, based on that as well, we see that, so based on that, we see that, we also see that, based on that information, we also see that we did the calculation of the expected return and the standard deviation, which is a measure of risk for a single asset. And then we also looked at the expected return and the measure of the standard deviation of a portfolio of securities as well. Now, when it comes to one measure that is used to determine the expected return is using the capital asset pricing model. So the capital asset pricing model is one measure that is used in ascertaining the expected return, right, for a single asset. Now, looking at this, if you check in the textbook, they say a common procedure is to use historical data and regression analysis to determine a best fit linear relationship between returns from an investment and returns from the market portfolio. So this relationship is the form of this particular formula, which is basically based on the capital pricing model, where R is the return from the investment. And then we also have RM, which is the return from the market portfolio. And the return from the market portfolio, a proxy for the return of the market portfolio is also going to be the return on a particular index as well. So if they say the return on a particular index, it's basically the same as the return from a market portfolio as well. So please make sure that you take note of that. Then they also say A and B are constants, and E is the random variable equal to the regression error. And we will explain exactly where A comes from And we'll also explain exactly where B also comes from as well. Now, looking at this, you will see that from the information that we're given, they also go on to say two uncertain components to the risk in the investment return are the first component being the beta and the return on the market, which is a multiple of the return from the market portfolio. Then the other component is basically the error term, which is unrelated to the return on the market portfolio. So which means that any excess return which cannot be explained there is basically going to be explained by this particular excess component. Then they say the first component is referred to as systematic risk. And the second component is referred to as unsystematic risk. So the first component that they're describing there describes the systematic risk. And then the second component that they're discussing there describes the basically describes the non-systematic risk. Now, before we go on further, we need to basically discuss exactly what is this systematic and unsystematic risk that they're talking about. So, the total risk of an investment is equal to your systematic risk plus unsystematic risk. This systematic risk, sometimes they refer to this systematic risk as non-diversifiable risk. And this unsystematic risk, they refer to it as diversifiable risk. So when they talk about non-diversifiable risk, we're basically saying that no matter how many securities you have in your portfolio, the risk of your overall portfolio does not change, it remains the same. So it's more like a fixed risk. So which means this risk, regardless of how many securities you have in your portfolio, the risk of the total portfolio does not change, it remains the same. So that's what we refer to as the non-diversifiable risk. Then the diversifiable risk is basically that risk that you're saying it's going to be reducing depending on how many different securities you have in your portfolio. So if you put this relationship between the total risk, systematic risk, and unsystematic risk as a graph, the relationship is more or less something like this. So we have total risk here. And then we have the number of different securities. So you find that in this case, looking at this relationship, so when you look at this particular relationship, the relationship as a graph would be given as something like this. So we are saying the more the number of different securities you have, this diversifiable risk basically goes away. Because remember, diversifiable risk basically means that is that component of total risk, which basically reduces depending on exactly how many different securities you have in your portfolio. So which means this diversifiable risk goes away the more different securities you have in your portfolio. Then at the same time, this systematic risk remains the same, regardless of how many securities you have in your portfolio, because this systematic risk basically, in a particular economic system, it basically affects everyone in the economic system. And because it affects everyone in the economic system, whether you have security A, security B, security C, security D, they are all going to be affected by this type of risk in an economic system. Hence, we deem it to be what? Non-diversifiable, in the sense that no matter how many securities you have, it remains the same. We go to the same page so far when it comes to the relationship between systematic risk and non-systematic risk. Now, when you now look at the relationship between how do you measure total risk and how do you measure systematic risk as well? Your total risk is measured using the standard deviation. Your total risk is measured using the standard deviation, which is also given by this particular sign as well. So in the previous section, which is section 1.1 and 1.2, when we were calculating standard deviation, we were trying to ascertain total risk. Then we also have systematic risk, and the systematic risk is measured by the beta. And the sign for the beta, normally it's a sign where there's a B with a long tail. We're on the third page so far. Any questions? Anyone lost? Moving on. Oh, here they say, consider first the non-systematic risk. If we assume that the E variable for different investments are independent of each other, the non-systematic risk is almost completely diversified away in a large portfolio. So an investor should not therefore be concerned about non-systematic risk and should not require an extra return above the risk-free rate for bearing non-systematic risk. So, which means the systematic risk component is what should matter to an investor. So we're basically saying, under normal circumstances, assuming that the investor follows the principle of diversifying their risk in their portfolio, what are we saying? Please put your microphones on mute. Please put your microphones on mute. So, under normal circumstances, the principle is an investor should diversify away their risk in the overall portfolio. And if they diversify their risk in the overall portfolio, it basically means that we are saying that the only risk that should be relevant to an investor is the systematic risk, because if their portfolio is well diversified, then the only risk measure that they're going to be worrying about there is the systematic risk as shown by the beta. So which means the beta should be the risk component that's going to be relevant to a particular investor, considering or assuming that this investor is going to be fully diversified, where they do away with their diversifiable risk and they're only going to be worrying about what? Systematic risk. Are we on the same page? Any questions? Anyone lost? Moving on. So in the next section, they give us the formula for the capital asset pricing model, where they say, with the capital asset pricing model, the expected return is given as the risk-free rate of return plus beta in brackets, the market return, the expected return of the market minus the risk-free rate of return. And this is the capital asset pricing model. So with the capital asset pricing model, we are saying, now, before we move on to the capital asset price model, for you to see exactly where it links with other analysis as well, it basically emanates from that general formula for interest rate pricing, where we say with interest rate pricing, your nominal rate of return is given as the real rate of return plus inflation premium plus risk premium. So your nominal rate of return is given as the real rate of return plus inflation premium plus risk premium. So you'll see that many of these models that we're going to be looking at, they are based on this basic principle where we're saying your nominal rate of return is given as the real rate of return plus inflation premium plus risk premium. Looking at this formula, it also means that the real rate of return plus inflation premium, we refer to this as the risk-free rate of return, which means your nominal rate of return is given as the risk rate of return plus the risk premium. Now, when you now look at the capital asset price model, we're basically saying, with the capital asset price model, your expected return is given as your risk-free rate of return plus beta, your market return minus the risk-free rate of return. So this is how we're able to ascertain the expected return. So do you see that this formula for the capital asset pricing model is very much related to this one? The reason being, we said when you look at this formula, we have the risk rate of return plus the risk premium, because if you look at this formula, we know that the market return minus the risk rate of return gives you the market risk premium. So your market return minus the risk rate of return gives you your market risk premium, which means your expected return can also be given as your risk rate of return plus your beta multiplied by the market risk premium. So this risk premium is basically the RP that we're talking about, going back to the original equation that we looked at. So this is the formula that we're going to be looking at when you look at the capital asset pricing model. Any questions so far? Any questions? Anyone lost?
Just a question there. That R star plus, what's that? Like that RF in green. What, yes, those two.
You mean the R with the star?
Yeah.
So this is the real return.
Okay.
So this is the real rate of return.
And then the other one plus, yeah.
Nominal rate of return.
Okay.
And this is the inflation premium.
Okay.
And this would be the risk premium.
Okay, thank you.
All right. Any other questions? So going back to the text.
Sorry, Moshe. I'd like to know during the assessment if these formulas will be given.
No, they don't give you any formula. They are, the assumption is that you should be knowing this formula off by heart. So they don't give you these formulas.
Okay.
when you look at the capital asset pricing model, we are saying in determining this expected return, the risk factor that are going to be taken into account is the beta. So what does that mean? What does that mean? It means in this case, remember we said your total risk is measured by the standard deviation is given as your systematic risk plus what unsystematic risk is. So the capital asset pricing model assumes that because the portfolio is fully diversified, unsystematic risk is not relevant anymore because you're assuming that your portfolio is fully diversified, which means the only measure of risk that you're going to be worrying about is the systematic risk as measured by the beta. So that's what one of the assumptions of the capital asset pricing model. That's why you see that the capital asset pricing model does not take into account anti-systematic risk. It assumes it's fully diversified, which means you're only worrying about what? The systematic risk. That's why you see that on this formula, we don't put this. When we say this is the anti-systematic risk. On this formula, we don't put this at all. Because it's not relevant, because we're assuming that the portfolio is fully diversified. Now, before we go on to the graph, there's something else I need to explain. Remember we said with the capital asset pricing model, the relevant measure of risk is the beta. So which means when you look at the capital asset pricing model, the relevant measure of risk that we need to account for when determining the expected return is the beta. Now we need to go further to say, so what really is this beta that they talk about? What really is this beta that they talk about? From mathematics, we were told that the gradient of the curve is given as change in x, change in y, over change in x. So we're given that the gradient of the curve is given as change in y over change in x. And that's how we ascertain the gradient of the curve. So the gradient of the curve is given as the change in y over change in x, right? Now, where is all this coming from? If you go to the graph that they're giving us, they give us the graph which graphs the capital asset pricing model, where we are given the risk rate of return, which is the element of the capital asset pricing model. We were graphing the expected return of the market, which is the element of the capital asset pricing model, where we look at the value of the beta as well, which is basically part of the element of the capital asset pricing model as well. So looking at this graph, we're saying if we plot this relationship, we have the expected return plotted against the beta, which is the relevant measure of risk for the capital asset pricing model. And plotting this as well, we see that the risk-free rate of return, a risk-free rate of return is the return that you earn without incurring any risk at all. So a return that you earn without incurring any risk at all is what we deem to be the risk-free rate of return. So which means on our graph for the expected return, our risk rate of return in this case effectively is that return that you're going to be earning without incurring any risk at all. So when your risk, remember your starting point is here at 0. When your risk measure is measured by beta is at 0, you are earning 10. So this return that you earn without incurring any risk at all, we deem it to be the risk-free rate of return. Now, please take note as well that when you look at this risk rate of return, one measure to try to confuse you in the exam, sometimes they might not even give you to say, this is the risk rate of return. They will tell you that this is the return on a treasury bill. So if they say the return on treasury bills, you can also deem that to be the risk rate of return. Reason being, if you invest in treasury bills, which are those short-term government security, short-term securities issued by the government, with usually a maturity date of 90 to 91 days, you also find that with those securities, the risk is deemed to be nil or zero if you invest in these securities, because these securities issued by the government, even if the government is in financial trouble, there's so many different ways that the government can utilize to raise money, pay you back that money. One way that the government can raise that money is through taxes. Like, for example, if you still remember, not so long ago, the government increased the value-added tax from 14% to 15%, mainly because the government needed money, and one way that the government was going to raise money is by raising value-added tax. Another way that the government can also raise money, which is a bit extreme, is where the government can simply print money and use that money to pay back its debt as well. So because there are different ways that the company can raise money, it basically means that the return on these short-term securities is deemed to be a risk rate of return, because they're saying if you invest in these securities, there's a very good chance that the government is going to be able to repay you when the amount falls due. Now, when you look at this graph as well, another component that we need to link is the expected return on the market. So another component that we need to link in this case is the expected return on the market, which is a bit higher. So is the expected return on the market, which is this element. Now, this return on the market, we need to find out exactly as well, what does it link to? Now, please take note, by default, the beta of the market is always equal to 1. So by default, the beta of the market is always going to be equal to, this is the beta of the asset, sorry, this is the beta of the asset. Please take note, the beta, we're going to get this. The beta of the market is always equal to 1. So please take note that the beta of the market is always equal to 1. Why it's equal to 1? That's an explanation for another day, because when you get the beta of the asset, the beta is basically saying the gradient of the curve, the change in y over change in x. So the change in asset return is your change in y. And your change in market return is always your change in x. So your change in asset return is your change in y, and your change in market return is equals to change in x. So which basically means when you look at this formula, it also means that your beta can also be given as your change in y, which is your change in the asset return, divided by your change in x, which is a change in the market return. So the change in the asset return, which is what you find on the what you also find on the y-axis, and changing the market return, which is going to be what you find in the x-axis. Because now, when you look at this as well, it means the gradient of the curve is basically a curve where you are given the asset return and the market return as well. So the return in the asset and the return in the market. So that's basically what the gradient of the curve looks at. Changing y over changing x, where your y is the market return and your x is your your y is your asset return and your x is your market return. So when you plot these two together, that's when you're going to be looking for the gradient, which basically means that you're changing y, which is a change in the market return, divided by the change in x, which is a change in the market return. It gives you the gradient of the curve. So the change in y, which is the change in the asset return, divided by the change in x, which is the change in the market return. That's basically how you're able to determine the gradient of the curve. Are we on the same page so far? Any questions? So since the change in the market return is on the denominator, when you're finding the beta, your denominator is the value, whatever value that you get for the beta of the asset, you assume that the beta of the market is always going to be 1, because remember, any number divided by 1 is that number. So whatever value of beta you calculate, even if you do the calculation for the change in asset return over the change in market return, whatever amount you're going to get there, note that the value is just going to be whatever value that's calculated there divided by 1, which means by default, we're basically saying that the market return is always going to be equal to 1. So which means when you calculate when you're now determining this particular curve as well, you should also note that when you look at this particular curve, the change in the market return is always going to be plotted by the value of beta being equal to 1. So whatever change in the market return that you're going to, the expected return that you are going to be, the expected return in the market that you're going to be using there, the beta or the corresponding beta in that case is always going to be equal to 1. And please take note as well that one proxy that is used in estimating the expected return in the market is the return on a particular index. So if they say the index generates so much as a return, take note that that's your proxy for your expected return in the market when you're looking at the capital asset pricing model. Now, when you look at the capital asset pricing model, remember we said with the risk rate of return, which will show exactly where it plots along the capital asset pricing model line. Then we also looked at the market return, which we said we also know exactly what it corresponds to when it comes to the beta. Then whatever asset return that you're going to be calculating there, which is the expected return of the asset. So whatever asset return that you're going to be calculating there, it's going to be corresponding to a certain value of beta, which you still need to be able to determine or given in a particular scenario as well. So the expected return of the asset is going to be corresponding to a certain value of the beta, which you still need to be able to calculate as well. So this is the reason why when you look at this particular graph, that's why that graph is drawn as something like this, which shows you the risk rate of return, the expected return of the market, which corresponds to a value of beta, then the expected return of the asset now is going to be dependent on exactly whatever beta you're given on the particular scenario. Now we're on the same page. Any questions? Anyone lost?
Menier, I was of the understanding that the beta in this equation represents the total amount that we have in our portfolio to invest. Am I wrong in that conclusion?
It's not the total amount of you have to invest in a portfolio. That's not correct. The beta represents, remember we said when you look at the total risk, beta basically measures risk. Not the total amount in your portfolio, it measures risk. So the total risk exposure in your portfolio is measured by the standard deviation. But if you're assuming that your portfolio is fully diversified, then it basically means that the measure of risk that are going to be relevant to you is based on the systematic risk as measured by beta. So beta measures systematic risk of the portfolio. It's not the amount of the portfolio or total amount of the portfolio. It's basically, it measures the systematic risk of the portfolio. Are we together?
Yeah, I understand.
So beta, just like standard deviation, they are both measures of risk.
And then one more question in the equation of the expected return. It says ER is equal to RF, and then it then again minuses the the risk-free rate from the market return. What does that imply? Does it imply that when we borrow at a risk-free rate, or when we invest in the risk-free investment, is it automatic that we are also going to borrow, and thus that is why we are paying for the risk-free rate via the market return? I don't know if you understand my question.
I'm not sure, but the original equation, remember we looked at the original equation here, right? And we said this determines the return plus the risk premium. So when you borrow, the risk premium that is going to be charged when you borrow money is dependent on exactly what your risk profile looks like. The higher your risk profile, the higher the interest that's going to be charged. Are we on the same page? The inverse of that
Yes.
is the same if you invest money as well. The more risk you are going to be taking on your portfolio, in your investment, the higher the return that you're going to be earning. So do you see that the interest that is charged when you borrow money, or the interest that you earn when you invest money, they're basically all based on this basic principle of the interest rate. So the expected return that we're talking about here, we are looking at it from a perspective of an investor, not a borrower. So from an investor perspective, that's why you see that if you go further with financial management, that's why you see that when you go further with financial management, sometimes they basically, please push your microphone on mute. That's why you see that when you go further with financial management, the expected return using the capital asset pricing model can also be used as an estimation of the expected return of your equity investment. But we do not going to be worrying about it for now. Are we on the same page? Are you answered?
Yes, I'm answered, man.
Okay. So the expected return that we're talking about here, we are looking at it from an investor's perspective to say, if you're an investor, how do you determine the return that you're expecting to get from your investment? Assuming that your portfolio is fully diversified. You have a fully diversified portfolio, which means that the expected return is going to be dependent on what? The risk exposure of the beta, which looks at systematic risk. Can you move on?
Yes.
All right. Any other questions before we move on? Any other questions? Now, on the next section, they give us an example where we look at the calculation of the expected return. But now, before we look at the calculation of the expected return, there's something else I need to address before we look at the calculation of the expected return, I need to break down beta further so that you understand the different ways that they can also bring in this concept of beta as well. Now, looking at the concept of beta, please take note that, remember we said your beta basically measures the gradient of the curve when we plot the return on the asset against the return on the market, where the return on the asset is the change in Y, and the return on the market is changing X, right? So that's what we said looks at the beta. So which means when you look at the beta being given as the change in asset return over the change in market return, it basically means that the beta can also be given. So the beta can also be calculated as the covariance of the asset and the market divided by the standard deviation squared of the market. And the standard deviation squared of the market basically gives you the variance of them. Remember, when we're looking at the measuring the risk of a single asset and also measuring the risk of the portfolio of investments as well, we said to get to the standard deviation, first, you need to calculate the expected return. Secondly, you need to calculate the variance. Then the square root of the variance gives you standard deviation. So the standard deviation to the power of 2 basically gives you the variance. So the beta can also be given as the covariance of the asset in the market divided by the standard deviation squared of the market. And the standard deviation squared of the market is basically your variance. Are we on the same page? Now, we are going to look at this.
I'm sorry to cut you off. By
Yes.
covariance, what do you mean, Munir? Is that the change in Y that you're talking about?
No, when it comes to the calculation of the covariance, the calculation itself for Rsk4805, even when we go on further there, you don't need to worry about that unless we are going to be using those different models as well to calculate the covariance, but you're not going to be worrying about the calculation itself. But it's basically showing you the relationship of the variance between the asset and the market. So you look at the relationship of the risk measure, where you look at the relationship between the variance of the asset and the market. That's basically the covariance.
Okay.
Now, this formula can also be given as, so this formula can also be given as the correlation coefficient of the market and the asset multiplied by the standard deviation of the asset multiplied by the standard deviation of the market. And remember, this is being divided by the standard deviation squared of the market. Are we on the same page so far? This beta.
Can you just repeat that one? I didn't catch you there.
So to get the beta, your beta can also be calculated as the correlation coefficient of the asset in the market multiplied by the standard deviation of the asset multiplied by the standard deviation of the market divided by the variance of the market. Remember we said the variance of the market is the same as the standard deviation to the power of 2 of the market. Are we on the same page? Now,
yes.
Standard deviation times standard deviation is the same as standard deviation squared. So your standard deviation times your standard deviation is the same as the standard deviation squared. So which means this beta can also be given as the correlation coefficient of the asset in the market multiplied by the standard deviation of the asset multiplied by the standard deviation of the market divided by the standard deviation of the market multiplied by the standard deviation of the market. Remember, this is the same as this. Are we in agreement? Which means your beta can also be ultimately be given as, if you look at this formula, we can see that the denominator here cancels the numerator there, isn't it? Which means your beta can also be calculated as the correlation coefficient of the asset in the market multiplied by the standard deviation of the asset divided by the standard deviation of the market. So this is another way that we can also be able to calculate the beta. So if you are given the correlation coefficient of the asset in the market, and you're given the standard deviation of the asset, and you're given the standard deviation of the market, you can use this information to calculate the beta. The reason why I'm explaining this is because one of the previous exam papers as well, they were asking you to determine the beta on the capital asset pricing model, but they didn't give you the beta. They gave the correlation coefficient, and then they give you the standard deviation of the asset in the market, and you can use these to determine the beta as well.
So just so I understand, Mania, the correlation of the asset in the market, is it one figure?
Yes, it's one thing.
No, and it is also given.
In most cases, it will be given. Yeah, if they ask you to determine the beta, they will give you the correlation coefficient.
All right.
Please note, as a side note, the correlation coefficient always varies from -1 to +1. So your correlation coefficient cannot be anything greater than 1, and it cannot be anything less than -1. So are we on the same page, so that we can now be able to look at the example question that they give us on page 10? All right. On page 10, so on page 10, they give us example 1.1. And on this example, they say, suppose that the risk-free rate is 5% and the return of the market portfolio is 10%. An investment with a beta of 0 would give you an expected return of so much. And this, so which means we need to calculate to see exactly, so if the investment is a beta of 0, how much do we get as an expected return, although they give us there. And then they give us another scenario where the beta is going to be 0.5 as well. So can you quickly have a look at this? Then we'll go through together. So using the capital asset pricing model, can you calculate the expected return given that information? See if you'll be able to determine the expected return. So in this example, your expected return is going to be given as, so all the information that they give us, please take note that when you enter the values for calculating the expected return, or when you're calculating the standard deviation as well, when you enter the values, if you're given percentages, enter them as decimals. So that's the standard norm when it comes to calculation of your values when you're giving percentages for honors level as well. I want to explain it further because it's a bit different from how you used to approach it when you're doing your undergrad. So in this case, we are given that the risk rate of return is 5%, so it's 0.05, plus they give us that the beta is equal to 0. The market return is equal to 10%, which is 0.1, minus the sort of 10 of 0.05. So given this information, how much would you get as your expected return?
Zero comma 0.05.
So you get a value of 0.05. Which, if you multiply that by 100, it would be 5%. Now they also give us another scenario where we are calculating the expected return, given that the beta is equal to 0.5. So it would be 0.05 plus 0 in brackets, 0.5, sorry, 0.5 in brackets, 0.1 minus 0.05. So given this information, how much would you get as your expected return?
Zero comma 0.075.
0.075 multiplied by 100, it gives you 7.5%. And then if your beta is equal to 1.2, so if your beta is equal to 1.2, you expect the return is going to be 0.05 plus 1.2 in brackets, 0.1 minus 0.05. So given this information, how much would you get as your expected return?
Zero point 0.11.
So 0.11 multiplied by 100, it gives you 11%. You see something of interest. When your beta is 0, our return is going to be the same as the risk rate of return. And when your beta is 0.5, our return increases to 7.5. And when your beta increases to 1.2, our expected return increases to 11%. What does that mean? If you take no risk at all, we assume you're going to be earning a risk rate of return. Just like what I was explaining when we look at that graph for the chemical asset price model. When you take no risk at all, you earn a risk rate of return. Then the more risk you take, based on the increase in risk rate of in the increase in beta, what does that mean? As an investor, you want to be compensated for the increase in risk premium by an increase in what? Expected return as well. Are we on the same page?
Can I just ask something quickly? Where do you get that 100? How did you get to multiplying by 100 on your second step?
You need, when you're converting decimals, remember we put in our values as decimals, isn't it? But an expected return is a percentage. So since the expected return is a percentage, whatever amount we have there, we need to convert the decimals to a percentage by multiplying by 100.
Oh, sorry. Thank you so much. Okay.
Any other questions? So just below this example, they are basically explaining what you've already covered before, where we look at the beta, where they say the parameter beta is equals to the standard correlation coefficient multiplied by the standard deviation of the asset divided by the standard deviation of the market. And I showed you exactly how they end up having this particular relationship as well. And then now, the next section that we're going to be looking at, we're going to be looking at the assumptions with regards to the capital asset pricing model. And remember, this section of the capital asset pricing model, the lecturer loves to bring this section as well. And sometimes they also combine it with the section where we look at what determining the alpha of your returns. So as a potential theory question, or even as a true or false question as well, they can ask you about the assumptions underlying the capital asset pricing model as well. So please take note of it. Potentially as a theory question, the lecturer has to bring this as what? As a theory question as well. So looking at the assumptions of the capital asset pricing model, they say the reasons why the analysis leads to conclusions that do not correspond with the realities of markets is that in presenting the arguments, we implicitly made a number of assumptions. In particular, and the first assumption being, we assume that investors care only about the expected return and the standard deviation of return of their portfolio. So that's the first assumption. And the second assumption is that we assume that the E variables for different investments in equation 1.3 are independent. So they are basically independent of the calculation of the expected return of the asset. And the third one is we assume that investors focus on returns over just one period, and the length of this period is the same for all investors. And then the fourth assumption is that we assume that the investors can borrow and lend at the same risk-free rate. So this is approximately true in normal market conditions for a large financial institution that has a good credit rating. But it is not exactly true for such a financial institution and not at all true for small investors. So that's the other fourth assumption as well. Then the fifth assumption is that we did not take tax into consideration. Then the sixth assumption is that finally, we assumed that all investors make the same estimates of the expected returns, standard deviation of returns, and correlations between returns for available investments. So to put this in another way, we assume that investors have homogeneous expectations. When they talk about having homogeneous expectations, they're basically saying what? Investors have the same expectations. So they basically expect the same things as well throughout. Are there any questions regarding the assumptions of the capital asset pricing model? Next section, we look at the calculation of the alpha. So we look at the calculation of the alpha. And when we look at the calculation of the alpha, just to review, remember we said the expected return, when you look at it from a portfolio perspective, we're basically saying the expected return of the portfolio is given as the risk rate of return plus beta in the bracket market return minus risk of return. And then they are giving us this example as well. So can you quickly read through this example and we go through together? In example 1.2, they're saying if you assume that the beta is 0.6, the risk-free rate is 4%, and the market return is 20%, we can be able to calculate the expected return of this particular portfolio. So to determine the expected return of this particular portfolio, we're going to say the expected return of this portfolio is given as a risk-free rate of 4%, which is 0.04, the beta of 0.6, the market return of 20%, which is 0.2, minus the risk rate of return of 0.04. So given this information, how do you get the expected return of the portfolio? How much do you get as the expected return of this portfolio? You must be able to get a figure of 0.136. If you multiply that by 100, you get 13.6%. Now, they also give us another example where we are calculating the expected return of the portfolio, but in the next case, we are being told that the return on the market is equals to 10%. So 0.04 plus 0.6 in brackets, 0.1 minus 0.04. If you look at this calculation, you will see that the expected return of the portfolio will be equal to 0.076 multiplied by 100, which is equals to 7.6%. Then they also give us another scenario for the expected return of the portfolio, where they tell us that the market return is equals to minus 10%. So it's going to be 0.04 plus 0.6 in brackets minus 0.1 minus 0.04. And if you do the calculation there, you will get a figure of minus 0.044. If you multiply that by 100, you get 4.4%. So looking at this, the lower our market return for the risk that we're taking, the lower our market return for the risk that we're taking. So the lower our market return, the lower the expected return. And remember, this is going to be negative here. So when our market return goes down, the expected return is also expected to go down as well. So they say, looking at this, this is where the concept of the alpha basically comes in, where we are now trying to check to see exactly. So if this is our expected return, how do we use the expected? Remember, the expected return is that return that the investor is saying, for me to be happy with this particular investment, I should at least earn this amount as a return. So the expected return is that, remember the expected, that's why you see that the expected return sometimes is also referred to as the required rate of return. because the investor is going to be using this benchmark to say, if I'm going to say that the investment has performed very well, it must have met my expectation, or it must have met my required return. So which means your alpha basically is now going to be used to assess whether the investment has outperformed the what? Whether the investment has outperformed the required rate of return as well. So your alpha is given as the return of the portfolio minus the expected return of the portfolio. So your alpha is given as the actual return of the portfolio minus the expected return of the portfolio. So that's basically how we determine the alpha. So your alpha, which is your excess return. So your alpha, which is your excess return, is given as the actual return of the portfolio minus the expected return of the portfolio. So we know, looking at this as well, we can also further expand to say the alpha can also be given as the return of the portfolio minus, and we know that the expected return of the portfolio can be given as the risk-free rate of return of the portfolio plus beta, in brackets, the return on the market minus the risk-free rate. So the expected return of the portfolio is basically given by this. So I just basically plugging this to represent the expected return of the portfolio. To simplify this as well, if you expand this, it would mean this can also be given as the return of the portfolio. Remember, this has a coefficient of 1. So any number where that is given in the bracket there, you are assuming that the coefficient in this case is going to be 1. So in this case, the coefficient is -1. So -1 times Rf gives you minus Rf. -1 times beta gives you minus the beta, in brackets, market return minus risk-free. So if you expand this bracket, you end up with this particular formula. And this is the formula that they are giving us on page 11. So that's the same formula that they're giving us on page 11 on how to determine your alpha, which is your excess returns. And remember, this calculation of your alpha, your excess return can be positive if the actual return on the portfolio is more than the expected return. At the same time, your alpha can also be negative if the actual return on the portfolio is less than the expected return. Are we on the same page? Any questions? Anyone lost? Please put your microphones on mute. Please make sure that you put your microphones on mute. So to understand this better, they give us example 1.3. Can you quickly read through example 1.3? And then we go through it together. So in this case, they give us the beta, they give us the risk rate of return, and they give us the market return. And then they tell us that the portfolio manager's return is 9%. So the actual return on the portfolio is equal to 9%. So given this information, we should be able to determine the excess return that has been generated by the what? By the manager. So to determine the excess return in this case, we're going to say the excess return is equal to, which is your alpha. So your alpha is equal to the return of the actual return of the portfolio, which is the actual return determined by the manager, which is 9%. So it's 0.09 minus the risk-free rate of return, which they give us as 5%. So it's 0.05 minus the beta, which is given as 0.8 in brackets, your market return, which they give us as 7%. So it's 0.07 minus the risk-free rate, which is 0.05. So given this information, how much would you get as your alpha? So if you do the calculation there, how much do you get as the alpha?
0.38.
0 point? You get a figure of how much?
2.4%.
So yeah, you get 0.024, and when you multiply that by 100, you get 2.4%. So I basically say the portfolio manager has managed to beat our expectations by giving us an extra 2.4% from what we needed or from what we required. So the portfolio manager has managed to beat our expectations or to manage to exceed our expectations by giving us 2.4% from over and above what we required or what we needed as an expected. Are we on the same page? Any questions? Moving on. On section 1.4, they also look at another theorem that is used in estimating the expected return, and they refer to it as the arbitrage pricing theory. Just know it in theory, but we're not really going to go through it in detail, like how the formula is formulated as well. So here they say, arbitrage pricing theory can be viewed as an extension of the capital asset pricing model. In the capital asset pricing model, an asset's return depends on just one factor. And remember, that factor we said with the capital asset pricing model, the one factor that they're talking about there is where we said the only risk factor that determines the expected return is the beta. So that's where the capital asset pricing model basically would differ from the what? Arbitrage pricing theory. So they're going on, they go on to say, in arbitrage pricing theory, the returns depends on several factors. And in brackets, they say, these factors might involve variables such as gross national product, the domestic interest rate, and inflation rate. So by exploring ways in which investors can form portfolios that eliminate exposure to the factors, arbitrage pricing theory shows that the expected return from an investment is linearly dependent on the factors as well. Then on section 1.5, they also look at the risk versus return for companies. And they say, we now move on to consider the trade-off between risk and return made by a company. So how should a company decide whether the expected return on a new investment project is sufficient compensation for its risks? So the argument just given suggests that non-systematic risks should not be considered when accept or reject decisions in new projects are taken. Because remember we said we're assuming that the project, the investor's portfolio is fully diversified, so we don't worry about what? Non-systematic risk. So here they say, in practice, companies are concerned about non-systematic risk as well as systematic risk. So investors, they don't worry about non-systematic risk, but companies, they are worried about both non-systematic risk and systematic risk, which basically means we are saying companies are worried about the standard deviation because the standard deviation measures total risk. On the next section, they give us the section which looks at bankruptcy costs. And they give us a business snapshot which looks at or demonstrates bankruptcy costs as well. And here they say, several years ago, a company had a market capitalization of 2 billion and 500 million in debt. The CEO decided to acquire a company in related industry for $1 billion in cash. The cash was raised using a mixture of bank debt and bond issues. The price paid for the company was justified on the basis of potential synergies, but key threats to profitability of the company were overlooked. Many anticipated synergies were not realized, and furthermore, the company that was acquired was not profitable and proved to be a cash drain on the parent company. After 3 years, the CEO resigned, and the new CEO sold the acquisition for 100 million and announced that the company would focus on its original core business. However, by then the company the company was highly leveraged, because when you talk about being highly leveraged, it basically means that you are basically using a lot of debt financing compared to equity financing. So they say a temporary economic downturn made it impossible for the company to service its debt, and it declared bankruptcy. So the offices of the company were soon filled with accountants and lawyers representing the interests of the various parties. So these people directly or indirectly billed the company about 10 million per month in fees. So the company lost sales that it would normally have made because nobody was willing wants to do business with a bankrupt company. And key senior executive left, and the company experienced dramatic reduction in its market share. So the 2 years and 3 reorganization attempts, after 2 years and 3 reorganizational attempts, an agreement was reached among the various parties, and a new company with a market capitalization of 700,000 was incorporated to continue to remain profitable parts of the remaining profitable parts of the business. And the shares of the company were entirely owned by the banks and the bondholders, and the shareholders got nothing. So these are some of the bankruptcy costs of which is basically the consequences of what might happen when a company declares bankruptcy. So as a note, they say, when expected bankruptcy costs are taken into account, projects that have a high risk are liable to be rejected as unacceptable. So this explains why investors like companies to limit the overall amount of risk they take and reward companies that manage risks so that they meet earnings forecasts. And we also see this quite a lot when it comes to the relationship between being highly leveraged and what we saw during the pandemic as well, that companies that were highly leveraged, those are the companies that were also struggling financially, mainly because they were having those fixed cost of financing, and at the same time, their income levels were very low as well. So is there any question regarding bankruptcy costs? On section 1.5.2, we also look at financial institutions as well. We look at financial institutions, and when we look at financial institutions, they say one can argue about how important bankruptcy costs are for the decision-making of a non-financial company, but there can be no question that it is crucially important for a financial institution such as a bank to keep its probability of bankruptcy very low. Large banks rely on wholesale deposits and instruments such as commercial paper for their funding. And because of that, it basically means that they cannot afford to be having a very high risk premium. Because if they have a high risk premium, it means that the cost of borrowing is going to be high. And if the cost of borrowing is going to be high, it means that their profit margins are also going to end up going down as well. Then we also look at regulation. And here they say,
Sorry,
even
I just wanted to ask, I see we're going through all of these. How will we be tested on these in relation to the calculations?
historically, they've never really asked questions regarding this as well. That's why you see that I'm just going through it so that you know. But when it comes to the questions in the exam, not really much. But remember, the main idea is these issues are some of the issues that contribute towards what? the risk premium. And the higher the risk premium, the higher the interest rate that's going to be charged as well if you're going to be borrowing for investment purposes. Basically, that's what they're trying to explain.
Okay, so then now we're doing this with you. When we go through the cells, how do you suggest the approach? Because I can see it's a lot of information, but you already know what to focus on. So on our end, how do we approach this?
From this section, the calculation that I actually emphasized, you see those calculations that I did, and the theory question that, remember when you're going through this particular section, what I emphasized on was the assumptions of the capital asset pricing model. Make sure that you take note of it. The components of the capital asset pricing model, make sure that you take note of it. The alpha, which is basically the excess return generated by the investor, take note of it. Those three things from this section, those are the most important things that you need to take note of.
Thank you.
All right. Now, in investments, you also need to take into account the issue of regulation. And here they say, even if, in spite of the arguments that we have just given, the managers of a bank wanted to take huge risks, they would not be allowed to do so. Unlike other companies, many financial institutions are heavily regulated. So governments throughout the world, want a stable financial sector. So it is important that companies and private individuals have confidence in the banks and insurance companies when they transact business. So the regulations are designed to ensure that the probability of a large bank or an insurance company experiencing severe financial difficulties is low. So the bailouts of financial institutions in 2008 during the subprime crisis illustrated the reluctance of governments to let large financial institutions fail. So that's why you see that even from a South African perspective as well, there's other people who were calling for the bailout of UBS Bank, although it didn't happen. Then they also say regulated financial institutions are forced to consider total risk. So which means when it comes to financial institutions that are being regulated as well, they are not only going to be worrying about systematic risk, they also need to take into account unsystematic risk as well. On section 1.6, we look at risk management by financial institutions. And here they say there are two broad risk management strategies open to a financial institution. One approach is to identify risks one by one and handle each one separately. So this is sometimes referred to as risk decomposition. The other is to reduce risks by being well diversified. So this is sometimes referred to as risk aggregation. So both approaches are typically used by financial institutions. Please take note of this because they can potentially ask you as a theory question where they can ask you to define risk decomposition, or they can ask you to define risk aggregation, or they can give you a statement and say, is this statement true with regards, does this statement describe, for example, risk decomposition, or does this statement describe risk aggregation? When you look at what? From a true or false point of view. So please, as the potential theory question, take note of this. On section 1.7, we also look at credit ratings. And here they say, credit rating agencies provide information that is widely used by financial market participants for the management of credit risk. So a credit rating is a measure of the credit quality of a debt instrument, such as a bond. However, the rating of a corporate or sovereign bond is often assumed to be an attribute of the bond issuer rather than of the bond itself. Thus, if the bonds issued by a company have a rating of AAA, the company is often referred to as having a rating of AAA, which is not necessarily the case as well. And remember, they also give us these different ratings also that are given by the different rating agencies, like for example, Moody's and S&P as well. The ratings don't really need to worry about it. That's why I didn't highlight that as well. So this is where we come to an end when it comes to chapter 1, which is study unit 1 of the curriculum. Are there any questions? Any questions? Can you take a 10 minutes break until 3:45? Can you take a 10 minutes break until 3:45? Then at 3:45, we move on to learning unit 2. So at 3:45, we're going to move on to learning unit 2.